Hello, everyone. Welcome to today's webinar, proudly brought to you by Orient Futures Singapore and Singapore Exchange. I'm Linus from Orient Futures Singapore, a brokerage firm based in Singapore and a wholly owned subsidiary of Shanghai Orient Futures. It is our honor today to invite our senior analyst, Ms. Cao Lu from Shanghai Orient Research Institute, to give us her insights on rubber in the next few months. Cao Lu has 7 years of rubber research experience. She's dedicated to predicting the rubber futures price through fundamental research. She was awarded the title of Excellent Analyst by Shanghai Futures Exchange in 2021. Without further ado, let's welcome Ms. Cao Lu, please.
Hello, everyone. It's a great pleasure for me to make a presentation here. Our theme today is about the outlook for rubber in the first half in 2023. We know that since mid-January last year, the rubber futures price has been on the decline. Even during the surge in the crude oil price, the rubber futures price has not rebounded, which is mainly due to the weak demand for rubber. In September 2022, the rubber futures price rebounded from the low level, mainly due to 3 reasons. Firstly, in September, after the rubber futures contract entered the delivery months, the price difference between the spot and the futures market has narrowed a lot. Besides, the futures price was approaching the spot level of 12,000 yuan per ton. We could see that the short positions in the market has reduced sharply, driving the rebound of the futures price. Secondly, the main producing countries have more precipitation at that time, and the price of overseas raw materials increased, which also boosted the market confidence. Thirdly, in the third quarter last year, affected by the macro environment, the decline of the rubber futures price has exceeded expectation, resulting in the reduced enthusiasm to produce deliverables. In addition, the epidemic in Yunnan province at that time also outbroke, which caused the market to worry about the insufficient output of deliverables. In October, the rubber futures price fell again. On the one hand, the price rise in September lacked fundamental support, and there was callback pressure. With the rise of the rubber price, the production profit of the delivery products also increased, which improved the enthusiasm to produce deliverables. In addition, as the futures price rose, the non-standard arbitrage spread also expanded, and the arbitrageurs increased their short positions, which could surprise the rubber futures price. On the other hand, since October, under the background of the Federal Reserve's continuous interest rate increase, overseas demand has begun to shrink, which also led to pressure on the futures price. Since November, the rubber futures price has rebounded from the bottom. On the one hand, it is a passive rise caused by the reduction of short positions. Judging from past experience, short sellers have more initiative to reduce their positions when the futures price fell below 12,000 yuan per ton, which could provide some rebound momentum on the other hand. On the other hand, micro funds began to focus on the logic of domestic demand recovery. In addition, after delivery of the rubber November contract, the number of registered variants of rubber was much less than last year, which also triggered speculation. The price of raw materials have continued to be high in 2022, and rubber farmers were passionate about tamping rubber. Without extreme weather conditions, the rubber output was released normally. Besides, it is worth noting that Although the global production capacity has not yet reached an inflection point, the significant decline in new capacity has limited the growth pace of production. Since 2018, the global rubber output has been below 14 million tons. Although the price of raw materials has been high and the weather was normal, the production level did not break upward. We believe that an upward bottleneck of rubber output may have appeared. According to the prediction model, the global rubber capacity of production may decline during 2024 to 2027. From the perspective of rubber tree's life cycle, the accelerated release of new capacity has ended. However, according to the related forecast model, the inflection point of rubber capacity won't appear until 2024 to 2027. Although the output growth of traditional producing countries has slowed down or declined in the past few years, the output of emerging producing countries is still on the rise. The difference in the rhythm of capacity release is why the global rubber output remains high. The global rubber production capacity may decline during 2024 to 2027. In the first half of 2022, under the global inflation environment, the price of overseas raw materials has remained high. However, since the second half of the year, the impact of substantial shrink of overseas demand and the seasonal increase of supply has begun to be reflected, and the price of raw materials in the main producing countries has dropped sharply from the high level. Although the price of raw materials has dropped, rubber farmers are still passionate about tapping rubber at the present price. Without extreme weather conditions, the rubber output will release normally in this year. The inflection point of rubber capacity may not appear in this year. However, restricted by capacity growth potential, even under normal weather conditions, there is an upward bottleneck for rubber output. Seasonally, from February to May, the global rubber production will be at a low level. According to domestic demand side, in 2022, the heavy trunk sales continued to decline, leading to the reduced demand for OE tires. Besides, the demand for AR tires has also been surprised by several negative factors. Firstly, the production restriction and the policies of highway to the railway and highway to waterway have surprised the demand for road transportation. Secondly, in recent years, policies of controlling transportation overload have been strengthened, and the tire wear rate has decreased. Thirdly, under the constant disturbance of the epidemic, some tire factories were forced to stop production. With regard to foreign demand side, against the background of shrinking overseas demand, domestic tire exports have begun to decline since the second half of last year. Since the beginning of last year, the domestic trunk and bus tire operating rate has been lower than the same period in previous years, which led to slower consumption of raw materials. Benefiting from the policy stimulus, the domestic passenger car market accelerated its recovery in June and July last year. However, the effect of policy stimulus has weakened since August last year. The policy stimulus can only serve as a short-term boost. In addition, since the second half of last year, the export demand of passenger cars tires also began to decline. Affected by the epidemic, rest-days travel is limited, and the demand for replacement tires has declined. The domestic passenger car tire operating rate has been continuously suppressed in the second half of 2022. Since 2021, the overseas auto industry has suffered from chip shortages. The willingness to consume has been suppressed by insufficient production. The global shortage of automotive chips has still not been solved yet. Overseas automotive production have remained sluggish. Only after the problem of automobile chip shortage being solved, the overseas automobile industrial chain will usher in a period of restocking. However, according to relevant reports, the shortage of automobile chips is difficult to solve in the short term. Besides, automobile chip shortage has been solved, the overseas automobile industrial chain will usher in a period of restocking. Besides, since the second half of 2022, overseas market has begun to show signs of recession. In this year, the overseas demand for rubber may continue to be suppressed. The current rubber price is still in the process of verifying the bottom of the market and does not yet have the momentum of trade reversal. From a long-term perspective, the key factor driving the market reversal is on the supply side. That is, when the inflection point of rubber production appears, which is still in the verification stage. Before the trade reversal, the rubber price will be mostly range-bound. In this year, the focus of the market will still be on the demand side. After the domestic epidemic prevention policy was relaxed, domestic demand is expected to be restored. At present, the repair space of domestic demand is larger than that of external demand. In the short term, due to the further weakening of the overseas economy and domestic epidemic impact, the demand recovery may be less than expected, and the rubber futures price will still be under pressure. In the medium term, the domestic market will become the main growth engine of the world from the second quarter. At that time, the seasonal low production and improved demand side will provide rebound momentum for the rubber futures price. Thank you.
Thank you, Cao Lu, for your very valuable insights. We have earlier gotten some questions from our audience. For the first question, after the Spring Festival holiday, the rubber futures price has dropped substantially. What do you think was the main reason?
I think the main reason for the price decline was on the demand side. The recovery of rest days travel and the logistic transportation will take some time. In the short term, the weak demand performance could still surprise the rubber futures price. Besides, as the futures price rose, the non-standard arbitrage spread expanded, and with that, the arbitrageurs will increase their short positions, which has also surprised the rubber futures price since last week.
What do you think is the key factor affecting the long-term rubber price?
I think the key factor affecting the long-term rubber price is still on the supply side. When the inflection point of the rubber production appears, the rubber price would enter the bull market. It is expected that the global rubber production capacity may decline during 2024 to 2027.
What are your investment suggestions for those rubber futures investors?
In this year, we think that although the bull market of rubber may still not appear, the recovery of domestic demand will drive up the bottom range of rubber price. The seasonal low production and the improved demand side will provide rebound momentum for the rubber futures price in the second quarter. We recommend investors to establish long positions when the price drops a lot.
Okay, thank you very much, Tao Lu. We have come to the end of our webinar. So do stay tuned to our next webinar. And if you want to reach out to us, here are our contact details. Yeah. Thank you, everyone.